Today we're tackling inflation, deflation, and the Consumer Price Index or CPI, a key component of the Economic Factors and Business Information section of the Series 65 exam. The exam will test your understanding of how these concepts impact investment returns and client recommendations. You won't need to perform complex calculations of the CPI itself, which measures the average change in prices paid by consumers for a basket of goods and services. Instead, the exam focuses on what the CPI number means. A rising CPI signifies inflation, and a falling CPI indicates deflation. The most common exam question involving CPI tests your ability to calculate the real return or inflation-adjusted return. For example, if a client's portfolio earned 8% last year, but the CPI increased by 3%, their real return is not 8%, but 5%. You simply subtract the inflation rate from the nominal return. This concept of eroding purchasing power is critical. It's the risk that your client's money won't buy as much in the future, a significant threat for long-term goals like retirement. The exam will also expect you to differentiate between the two primary causes of inflation: demand pull and cost push. Demand pull inflation is often described as too much money chasing too few goods. Think of a scenario where the government sends out stimulus checks, increasing consumer spending and pulling prices up. This type of inflation is often associated with a strong, expanding economy. Cost-push inflation, on the other hand, occurs when the costs to produce goods and services rise, forcing businesses to increase prices. An example would be a sudden spike in oil prices, which increases shipping costs for nearly all products, pushing prices higher for the end consumer. A common exam trap is to confuse the two. Remember, demand pull is about excess demand, while cost push is about rising input costs. While inflation gets most of the attention, deflation can be even more dangerous for an economy. Deflation is a decrease in the general price level. This might sound good, but it can lead to a devastating downward spiral. If consumers expect prices to be lower tomorrow, they delay purchases. This widespread delay in spending causes economic activity to slow, leading to lower corporate profits and potential layoffs. For the exam, understand that during deflationary periods, fixed income investments like bonds generally perform better than equities. This is because the fixed interest payments from a bond become more valuable as the purchasing power of that money increases. A common point of confusion is mixing up deflation with disinflation. Disinflation is a slowing of the rate of inflation, not falling prices. For instance, if the inflation rate drops from 5% to 3%, that's disinflation. Prices are still rising, just not as quickly. Deflation means prices are actually falling. To keep these concepts straight, here's a simple mental shortcut: pull up prices with more demand, or push up prices with higher costs. This helps distinguish the two types of inflation. And remember that the purchasing power of a fixed income investor's dollars increases during deflation, making their investments more valuable in real terms. The exam will present scenarios where you must identify the primary risk to a client's portfolio. If a client is heavily invested in long-term bonds and the economy is experiencing high inflation, the primary risk is the erosion of their purchasing power. Conversely, in a deflationary environment, the bond portfolio would likely perform well, but the overall economic contraction would pose a risk to equity holdings. For free practice questions, AI-powered explanations, and more exam prep tools, visit openexamprep.com. That's openexamprep, all one word, .com.